U.S. citizens and resident aliens are taxed on their worldwide income, a core principle you must know for the exam. It doesn't matter if the income is earned in the United States or in a foreign country. It is all potentially subject to U.S. tax. An exam question will often give you a scenario about a U.S. citizen living abroad. For instance, imagine a U.S. citizen lives and works in the United Kingdom for the entire year. They earn a salary of $150,000 from a UK employer, receive $5,000 in interest from a UK savings account, and paid $30,000 in UK income taxes. Their UK bank account had a highest balance of $20,000 in June. Let's analyze this from an exam perspective. First, to address the salary, we look to Form 2555, the Foreign Earned Income Exclusion, the most important word here. And a frequent exam trap is earned. This form can be used to exclude foreign earned income, like a salary or wages, up to an annually adjusted limit. However, it cannot be used for unearned income. The $5,000 in interest from the savings account is unearned and not eligible for this exclusion. A classic exam question will list various types of foreign income and ask which ones qualify for the exclusion. To use Form 2555, the taxpayer must satisfy either the bona fide residence test or the physical presence test. The physical presence test is a numbers game the exam loves to test. It requires the individual to be physically present in a foreign country for at least 330 full days during any consecutive 12-month period. Next, we consider the $30,000 in UK income taxes paid. This leads us to Form 1116, the foreign tax credit. This form is designed to alleviate the burden of double taxation. The most critical interaction tested on the exam is between the exclusion on Form 2555 and the credit on Form 1116. A taxpayer cannot claim a foreign tax credit for taxes paid on income that they have already excluded. If our taxpayer excludes $120,000 of their UK salary, they forfeit the right to claim a credit for the UK. Taxes attributable to that same excluded income. The credit can only be claimed for foreign taxes paid on the income that remains subject to U.S. tax, which in this case would be the salary above the exclusion limit and the $5,000 of interest income. Finally, we must address the foreign bank account. This is where FinCEN Form 114, the Report of Foreign Bank and Financial Accounts, commonly known as FBAR, is relevant. The exam will try to trick you by mixing up tax forms and reporting forms. The FBAR is strictly a reporting requirement. A U.S. person must file an FBAR if the aggregate value of their foreign financial accounts exceeds $10,000 at any point during the calendar year. Notice the key phrases, aggregate and at any point. The exam might state the year-end balance was below $10,000, but the peak balance was above it, which still triggers the filing requirement. Or it might list several accounts that are individually below the threshold but whose combined value exceeds it. Another crucial detail is that the FBAR is filed electronically with FinCEN, the Financial Crimes Enforcement Network, not with the IRS. Penalties for failing to file are severe. To remember the FBAR essentials, use this phrase: FinCEN gets the FBAR for 10 grand or more any day. This connects the agency, the form, the threshold, and the timing rule, helping you keep these distinct facts straight under pressure.